Good morning, ladies and gentlemen. It's a great pleasure. My first time here at the one-to-one. Congratulations to England for the first victory. Actually, Austria, for moral and ethical reasons, does not participate in this World Cup. No, we didn't qualify. We just didn't qualify. I look forward to presenting you my thoughts regarding Koyaanisqatsi. That's not a new tool by the Federal Reserve or a new COVID variant or a new rap star, but this term means life out of balance. And I saw this movie and I thought, well, that's actually quite a fitting analogy for the environment that we're currently in. But first of all, a brief thank you to our premium partners. As you might know, we publish this In Gold We Trust report for 15 years now. We publish it in English, German, in Mandarin, and also in Spanish. We had 2 million downloads for this year's edition, and it wouldn't be possible to make it available totally free of charge without the support of our premium partners. So thank you very much. We're already working on a 2023 edition, will be published end of May. Now let us talk about Koyaanisqatsi. Who has seen the movie? Hands up. Really, Adam? Good job. Thank you very much. Well, actually, Koyaanisqatsi is a Native American Hopi word, and it means life out of balance. And as Adam said, it's also the name of a 1982 non-narrative film. And as you can see here on this quote, before you take any decision, consider its effect on the next 7 generations. This is how the Hopi tribe actually thinks. Pretty different to the politicians and the central bankers at the moment, I would say, whose time preference is very, very high. And 40 years later, this film and especially the soundtrack make an apt backdrop for today's investment environment. Because Koyaanisqatsi neatly captures current market conditions, which are in many ways a reaction to imbalances. Imbalances that have built for many years, if not decades, and are now suddenly erupting in various areas of life and various areas of financial markets. So I will talk about life and markets being out of balance and then put it into context what it actually means for your portfolios. Let's start with life being out of balance in society. Worldwide, the wealthiest 10% of the population are earning about 52% of all income and own between 60 and 80% of all assets, depending on the region. The poorest half of the global population earns about 8% of all income and collectively owns less than 5% of wealth. In contrast, the richest 10% of the global population owns 76% of all wealth. Now, I really don't want to sound like a social activist, but rather emphasize, ladies and gentlemen, that these inequalities are a direct consequence of our monetary system. And we're also obviously seeing life being out of balance when it comes to politics. We saw Brexit, obviously. We also see the crisis in Iran. We're seeing the political divide in the United States, recently also in Brazil. We're seeing that the Eurozone is becoming more and more divided. And as this great picture shows, well, we are actually having a war in the middle of Europe now. And life is out of balance in energy markets. Have a look at this chart. It shows energy costs in percent of GDP, 2020, 2021, and 2022. In a nightmare scenario by Goldman Sachs, energy bills would constitute over 20% of EU households' gross disposable income. This is up from 8% in 2021. This would mean up to 2 trillion additional costs. Just to compare, the GDP of the European Union is 17 trillion. And we're also seeing that life is out of balance when it comes to currency markets. Actually, if you got the US dollar right this year, your portfolio probably has done quite well. And if we compare, obviously, it to gold, well, gold suffered big time from the strength of the US dollar. If we compare it to the euro and the Japanese yen being down almost 25% year to date, which caused major interventions. And actually, short JGBs is at the moment one of our biggest risk positions in the fund that I'm managing. If we compare it to the British pound, or as many people now call it, the British pound peso, well, actually, we're seeing enormous weakness against the US dollar. But actually, who remembers this gentleman? He wasn't in his job for a while. But actually, if we compare it to the Canadian dollar, if we compare it to the Aussie dollar, or for example, to the Brazilian real or the Mexican peso, actually the strength of the US dollar isn't that convincing. So from my point of view, it is rather the weakness of the euro, the Japanese yen, and the British pound that we're seeing this year than the strength of the US dollar. And life is out of balance in bond markets. Most people are staring primarily on equity markets, but actually in bonds, well, this was the worst year since 1865. I don't know if anyone here remembers the big bear market in bonds in 1865. Yes? Yeah. It was a tough one. It was a really tough one. So actually, it's been a really brutal year in the bond market. And if we combine it with equities, and you can see on this chart on the x-axis, the S&P 500 total return, and on the y-axis, you see the 10-year treasuries. Well, actually, you can see that 2022, for a balanced portfolio, was the toughest year since 1928. And this is a major difference compared to 2008, because in 2008, well, actually, treasuries were up roughly 20%. So treasuries basically hedged your losses in equities quite well. And in 2009, equities did a good job of balancing out your portfolio. But this year, it's equities and bonds being down big time. And I don't know if you remember the Bud Spencer, Terence Hill movies. I loved to watch them as a kid. So Bud Spencer always gave this, we call it in Vienna, the Stereowatschen. This one or this one. This is how he treated his friends. So this is actually the Bud Spencer Stereowatschen for your portfolio. Bonds and equities being down significantly. And life is also out of balance in the gold market. Have a look at this chart showing COMEX gold deliveries in millions of troy ounces. Well, actually, something has changed in 2020. Investors are now requesting physical gold. They don't want cash settlements anymore. Now, what is the reason that markets and societies and politics are out of balance? From my point of view, inflation obviously is one of the main triggers. Now, we wrote at length about inflation. I'm managing an inflation protection fund, so it's really crucial for us to understand where inflation is heading to. If we want to summarize, I would say the low inflation world stood on 3 pillars. First of all, cheap immigrant labor keeping service sector wages stagnant in the US. Secondly, cheap goods from China raising living standards amid stagnant wages. And thirdly, cheap Russian gas powering the German industry and the EU more broadly. So we could say that Russia and China have been the main guarantors of macro peace, providing all the cheap stuff that was the source of deflation fears in the West. And this gave central bankers the license for years of money printing in the form of quantitative easing. But now those three pillars of the low inflation worlds have changed. And central banks are done fighting deflation with asset price inflation and are now fighting inflation with asset price deflation. So today's inflation is more about supply and less about demand. And it is more about geopolitics than domestic politics. Have a look at this chart. It shows the great moderation, 4 decades of falling inflation rates. Well, actually, there are very, very few market participants left that actually know how to navigate in an environment of rising and of high inflation. We are all used to this great moderation, 4 decades with falling inflation rates. And it's not only wealth managers, fund managers, it is also algorithms that actually don't know how to navigate in an environment of high inflation. Ladies and gentlemen, I did keynotes in 35 countries all over the globe, and the best questions about gold were always asked in Turkey. Turkish people know everything about gold. Why? Because they're used to a rubbish currency. They're used to high inflation. And I think this attitude will come back over here in the Western world as well. I think that inflation will become one of the first things to consider when you're constructing a portfolio. And we published a special report called The Boy Who Cried Wolf in fall 2020, where we said, actually now is the time to slowly start raising interest rates. But it seems that the ECB and the Federal Reserve don't read Incrementum reports so far. However, from my point of view, this inflation wave, and I'm speaking primarily about the United States, I think this inflation wave is about to tend lower. You can see on this chart the break-even inflation rates, 10-year and 2-year, and the CPI. And actually, the break-evens already made their highs in spring of this year. And normally, CPI will follow. So for the United States, I expect inflation rates to surprise on the downside for the next couple of months. Now, what does that mean? It takes an enormous amount of pressure from the Federal Reserve. They will have more leeway to actually step on the brakes and perhaps reverse their policies. However, from my point of view, this is only the end of one inflation wave. I expect another inflation wave probably in 2 or at the latest 3 years. But markets will be focusing on the disinflationary pressure. Let's have a look at this chart. The table shows actually that recessions are clearly disinflationary. So from my point of view, we are heading into an environment where markets will focus less on inflation and much more about the recession. Actually, if you have a look at the speeches from former Fed officials like Bill Dudley, they're sometimes really interesting and they even sometimes tell the truth. Bill Dudley, former president of the Fed New York, he said in April, if financial conditions don't tighten on their own, the Fed will have to shock markets to achieve the desired response. It will have to inflict more losses on stock and bond investors than it has so far. So this is called the reverse wealth effect. And well, so far they did very well on this reverse wealth effect. More capital has been destroyed in the past 6 months than in any other previous bear market. So far this year, 60 trillion in market cap were wiped out from capital markets. This is roughly 60% of global GDP, or much more than the combined GDP of the US, China, Japan, India, France, UK, Brazil, and you can add some more smaller countries like Austria, Liechtenstein, whatever to this. So 60% of global GDP were wiped out from capital markets. And of course, it has effects on the economy. I said that previously at a presentation. A friend of mine, he probably is, I don't know, he's got a couple of €100 million. And he told me, well, actually, if I have a look at my accounts, I feel really, really poor. So I canceled my subscription for the golf club. And I said, well, actually, doesn't make any big difference. But human beings don't always act rationally. And I think we're seeing these consequences of this inverse wealth effect. If you have a look at consumer sentiment, for example, actually we have seen an all-time low in US consumer sentiment. The weakest reading in 70 years of history. So this is lower than during the Vietnam War and the Arab oil embargo, the 1987 crash, the COVID crisis. So I just don't see a soft landing happening. I just don't see it. But many people still say, well, actually, the US economy is doing very fine, still very resilient. One of the reasons, from my point of view, is actually that US consumers are maxing it out. Have a look at US consumer loans, especially credit cards, going through the roof. There was a fantastic interview with the CEO of Walmart recently, and he said that US households don't pay their grocery shopping with debit cards or cash anymore. They're using their credit cards. Probably not a sign of a very, very healthy economy. Now we, financial markets people, we probably always think that the market is discounting everything right away. But business owners and consumers, they are now only slowly feeling the pain of the rate hikes. So I think more pain is ahead. And we're seeing already that the top 10 leading indicators, it's a fantastic indicator, ladies and gentlemen. The US Conference Board ranks the top 10 economic leading indicators and wraps them into a diffusion index, which you can see on this chart. And every time the index prints 2 or more times below zero, we are already in a full recession. And this index correctly forecasted 5 out of 5 recessions since the 1980s. We're clearly seeing we're below zero now. And we can also see for the ISM, for example. ISM manufacturing PMI, usually when it goes below 50, so when it's in contraction mode, the Federal Reserve starts lowering interest rates. So from my point of view, ladies and gentlemen, we are coming to the very end of this rate hike cycle. I'm very, very certain about that because we're moving into a full-blown recession. Now, monetary policy is also obviously out of balance. Jay Powell said in June 2022, I think we now understand better how little we understand about inflation, which is an utterly remarkable concession by the head of the Federal Reserve. And they employ, I think, 400 PhDs. So if he doesn't understand it, well, actually, why should we understand it? And Madame Lagarde in Frankfurt, she said, I see an inflation profile that looks like a hump. We are firmly of the view, and I'm confident that inflation will decline in 2022. Now, I don't want to criticize Powell and Lagarde too much here, but I want to emphasize that it's sheer unbelievable that the market now believes that this time they know about the future, that this time they're making the right forecasts. Because actually the track record of central bankers, if they would be in private markets, I think they would be out of their jobs pretty quickly. So I just don't buy into this hawkish narrative. And I think that Jay Powell will be nominated for the upcoming Oscars. And have a look at this chart. Only 3 out of 20 rate hike cycles did not end in a recession. Ladies and gentlemen, we've got the highest debt levels ever. Therefore, we've got the highest sensitivity to rising interest rates. The Federal Reserve has doubled its balance sheet since 2020. And US non-financial credit is up 50% to 67 trillion US dollars. In this environment, the Federal Reserve has raised rates by 375 basis points in just 8 months. I have never, ever witnessed such an obvious recipe for a policy disaster than now. And many people still believe that Jay Powell is the new Paul Volcker. Well, actually, I think his wiggle room is much smaller. In this year's In Gold We Trust report, we compared the stagflation of the 1970s to the current stagflation. And the main difference, probably, ladies and gentlemen, are debt levels. Debt levels on a government, company, and household level are between 2 and 3 times as high as back then when Paul Volcker was around. And another big difference, Ludwig von Mises said, people are complaining about inflation, but they enthusiastically support policies that can only be accomplished with inflation. Another major difference, ladies and gentlemen, is the political support. We know that Jimmy Carter swore in Paul Volcker, and afterwards Carter lost to Ronald Reagan. But Paul Volcker had full support by the White House. Now, if we're moving into a recessionary environment with unemployment rates going up next year, do you really think that Jay Powell will have the full support of the White House? I doubt it. I'm seeing tremendous pressure on the Federal Reserve for the next year. Now, when it comes to gold, well, actually, many people are quite disappointed. And life is all about expectations. If you would have told me last year that inflation numbers at roughly 8%, and actually there's a war in Europe, I would have forecasted price of gold to be higher. But as I've said, life is about... can you play the video? Just click. Life is about expectations. So I think the fact, ladies and gentlemen, that as I've showed you before, we're seeing one of the weakest years for bond markets, one of the weakest years for balanced portfolios, and that gold is actually trading very close to its all-time high for the world gold price. I think that's actually a pretty good sign. If you have a look at this table, just to put it into perspective, gold in US dollar terms is now down 4%. In British pound terms, gold is up 11%. In Japanese yen terms, it's up 18%. In euro terms, it's up 7%. So I think gold did its job pretty well in most currencies, but in US dollar terms. However, if you have a look at 2019 or 2020, for example, the 2 years after the last big pivot, actually gold did tremendously well also in US dollar terms, up 18% and then up 25%. However, the sentiment in the gold camp is very, very negative. You can see the optics indicator by sentiment trader here. We're actually at levels, I think the last time we were there, basically right before the last big pivot from the Federal Reserve. And we saw in September, I think, the Wall Street Journal had this article on their front page, Gold loses status as haven. It reminded me of this infamous The Death of Gold piece in the Financial Times, which actually almost exactly nailed the bottom in the last big bear market of gold. 1999. Yeah. No, that was 1999. Now, if we have a look at the mining space, I know, I've did 2 conferences before. I know that the sentiment in the gold industry isn't, how should I put it, extremely positive. However, the large companies are still doing pretty well. Of course, they are facing cost inflation. Of course, they are dealing with the fall in the gold price, but actually their margins are pretty healthy. And ladies and gentlemen, inflation is not a catastrophe. I think it's our job as investors and business owners to adapt to rising input costs. And I've had many conversations talking to companies basically saying, well, we're changing, we're adapting, we're trying to live with those rising input costs, and we try to improve the situation. But still, the large mining companies are doing very well at the moment. Now, miners are extremely oversold relative to gold. I would never use that as a timing indicator because actually we're that undervalued relative to gold since 2015. But it just puts the valuation of the mining space relative to gold into perspective. Something about the technical situation. Well, actually, November is kicking off by far the best season, the best seasonal pattern for gold. November actually has the best seasonals, while December and afterwards also January and February are, from a seasonal point of view, really good years. Again, I would never trade just on the seasonal setup. But I think at the moment, from a risk-reward perspective, this is a pretty exciting setup. Now, where is this leading to? In the summary of this year's In Gold We Trust report, we wrote, we believe it is illusory that the Federal Reserve can deprive the market of the proverbial punch bowl for any length of time. And we seriously doubt that the transformation of doves into hawks will last. Most hawks will merely turn out to be doves in hawks' clothing and will shed their hawkish garb sooner rather than later as a result of the inevitable consequences of monetary tightening. Recession, rising yields, stock market corrections, bankruptcies, and unemployment. And I think we are right on track. I think that the punch bowl has been taken away and we already saw many consequences. We are seeing stress in currency markets, in bond markets, obviously also in the crypto market. So those are all direct signs of this enormous monetary tightening that we're facing at the moment. And gold actually, in relative terms, it is extremely cheap. I always compare gold to other monetary aggregates, like the monetary base or M3. If we compare it to US federal debt, and this is all the peaks of previous big gold bull markets. Actually, on a relative basis, gold is probably one of the cheapest assets out there. I'm already coming to my conclusion, ladies and gentlemen. Decades of disinflation, the great moderation, have come to an end. We saw an inflation shock. Afterwards, the rate shock, and the next shock will be a recession shock. And this will lead to a pivot. I think the FOMC meeting, I think on 14th or 15th December, might probably show us the last rate hike in this cycle. But politicians will shield the private sector and will offset losses using the government balance sheet. But there has to be a release valve. It's either going to be currencies or bonds. And the current wave of inflation will peak soon. but inflation will continue in waves. And the crucial question for the gold market, and probably for capital markets in general, is when will monetary tightening stop? Now, from my point of view, ladies and gentlemen, as I've explained in my keynote, the recessionary clouds are getting darker and darker. And I just don't see the Federal Reserve continuing on this hawkish path. Actually, there wasn't only one movie called Koyanis Katsi, there was also a sequel. It's called Poya Katsi. And it's a rubbish movie. Don't watch it. It's really extremely boring. And Poya's Katsi had the subtitle Life in Transformation. So actually, ladies and gentlemen, coming back to my leitmotif, if we want to return to balance, we have to rebalance, we have to rethink, and we have to renew. The international monetary order, ladies and gentlemen, will be reorganized over the next couple of years. And I think that gold will play a central role in this reorganization of the monetary order. Thank you very much for your interest. I hope you enjoyed it, and I now wish you a terrific conference. Thank you very much.